Welcome back, everyone, to the Bank Customer Experience Podcast. My name is Bradley Cooper, and I am joined by Scott Smith and Scott Fieber from Cook Solutions Group. Great to have you on, Scott's, if you don't mind me calling you that.
Scott squared. He goes by Smitty just to make it easy on everybody.
Perfect. So you're joining us today because we really want to talk about efficiency ratios and specifically how FIs are reducing their efficiency ratios and maybe why a strategic workshop could work well in that regard. So if you had to say, how many FIs do you think have an efficiency rating over 90%?
I'm not going to take a guess. We actually just pulled this number. And I was actually shocked to see the number. I think the number we pulled is over 12% of all institutions in the United States are over 90%, which is kind of crazy if you think about it. I know it's been a kind of a tough landscape for the last few years in banking on profitability in general, but to see that many over 90% was definitely an eyebrow raiser for me at least.
Sure. Why do you think that number is so surprising?
Well, so, I mean, those that aren't familiar with the efficiency ratio, that's basically how much it costs to make a dollar, right? So the higher the number, the worse off you are. So the lower you get that, the more profitable the institution is. And so to be over 90%, that means it's, costing you over 90 cents to make a dollar. That's tough,
Sure.
right? So we're looking at just the rise in mergers and acquisitions happening is probably a big telltale piece beyond that is institutions that are not financially viable going into this. The other piece too is just obviously interest rates and the landscape changing consumers. There's a lot of darts being thrown at banks and credit unions today, which are not in their favor. And so I totally sympathize and understand where they're at. It's an interesting position to be in. And that's kind of where we're at here from CSG's lens, to try to figure out ways to help them get that number down and do it in a strategic way, right? Because there's always those numbers of, hey, drive more revenue and reduce costs. Like every business wants to look at that. Easier said than done, though, right? We got to figure out logistical ways and practical ways and strategic ways to go about doing it. And again, every market's different too, right? And obviously your asset size plays into that too. So there's a lot of smaller institutions that are out there that will naturally have a higher efficiency ratio. But I think we're looking at just the future and keeping some of those smaller institutions in the United States, trying to keep them viable financially is going to be a key goal for a lot of them.
Right. And I think you bring up a great point that it obviously can vary by the geography, it can vary by the size of the institution, it can vary based on all sorts of different variables. But let's keep things small and simple. So let's say you could reduce your efficiency ratio by 2%. What impact would that have on the bottom line?
Really simple math, right? Is that 2%? I mean, basically that just takes 2% to your bottom line. As Scott was discussing, hey, if you're 90%, you're only making 10 cents per dollar. What's an additional 2 points on that? An interesting thing to add to that too, just to bounce off what Scott was saying is, I think financial institutions today are really struggling too with a number of different aspects. One of those being vendor creep, one of those being FTEs, one of those being so much technology that's ready and available. How do I wrap my head around all of this technology while making the purchase and still getting the ROI? Like, where do we do the cost analysis? Where is the benefit to that? How does it actually decrease our operational costs, not only on a hard cost footprint, but actually on a soft cost as well? And so that's
Right.
kind of where we've done some things with CSG to try to help some of our customer base. One of those was a very large customer that's in our footprint, came to us and said, hey, we got to get costs down. And I said, okay, that's great. I can throw a discount at you and see if we can get costs down. And it just wasn't really the partnership we wanted. So we kind of said, well, let's holistically take a step back. What are you guys utilizing today? Where are some dual efforts being performed? What kind of costs do you have around standing up certain solutions and supporting them? And so what we were able to do is we were actually able to sit down with their whole C team, understand, where they were at, and actually ended up saving the credit union a big chunk of change. They were a very large volume customer for us, but it wasn't so much just on the products and services that we offered, but it was, hey, how can we help you as a vendor? And we actually established some new procedures that was actually going to, they were estimating it was going to save them around 25 hours a week of FTE time just on a specific bill changing methodology that we work together with them strategically on. So I think that's the biggest thing. If we could give a plug to any financial institution out there, would be like, hey, contact all of your I don't want to call them vendors, contact all your partners
If
and,
they are
and
partners.
ask them, yeah, be our partner. How can you guys help? Those are the relationships that I think can really do that. And when you do that across the board of all of your products, I think you could actually drive a lot of those ratios down to where you can start to manage those relationships and get what you're truly supposed to get out of your partner relationships. And that's a value, not a
Yeah,
product.
the honest piece too there, Bradley, is like if you would take that 2%, whatever bit is, I mean, that number is going to vary dramatically based off the size of the institution, right? That then pays for whatever strategic initiative you want to roll out, right? Instead of spending that money on inefficient practices and doubling down on bad purchases and bad protocols, hey, now we got some money that's freed up to do the fun stuff that we're kind of feeling the pressure to beforehand, or get back in line where you need to be to. I think to Smitty's point, though, there's also an interesting aspect here where what's digging into that efficiency ratio quite a bit is obviously there's a lot of regulation that's being thrown at banks and credit unions today too.
Right.
And it takes people, that takes bodies. And when you add more vendors on top of that, the management that goes into all these different vendors is insane. And especially on the reporting side, as far as what those regulators want to see and how those vendors are performing and what they're doing to protect the institution and their customer. To me, it's an interesting conversation to be had. Is we see this all the time. There's a lot of new companies popping up. There's a lot of really interesting bleeding edge technology coming out. And I would say the number one thing I've seen is before jumping into a brand new relationship with a new vendor for one product, go back to your current vendors and partners and see if that's something they could also provide. To Scott's point earlier, I mean, this conversation that was had was there's a lot of other vendors out there that could be consolidated into a CSG relationship, in which that's where a lot of those savings come in, and the efficiencies on the back end with all the soft costs, that's really hard to monetize, right? But you take it out one step further, even beyond that. It's okay, dollars and cents wise, we're better. But what's really hard to put on a spreadsheet, or at least on a profitability table, right, is all the integrations and all the improvement that comes along with that as well. So for our example, just kind of give you a really crude example of this, right? We do a lot of security and a lot of fintech stuff. Those customers that do both sides of that with us are then able to then integrate those together. And now we can drive better efficiencies for the risk team, the fraud team, operations, retail, you name it. Or beforehand, if those are siloed out because they're two different vendor relationships, that's not efficient, but neither are we then taking advantage of what could be with an integration that can come about as a result of it. So it's like I said, I think that's why I think it's key to have that C-suite together in that room. Because if it's a siloed decision on just operations, right, or just technology, the lens can just be siloed to that one view, right? When you get the entire executive team together, collaborating on what are our initiatives and how can we bring this together, you'll start seeing the commonalities that come about this. And I think just as technology evolves over the next couple of years, this can become more and more important, in my opinion.
Sure. I think those are all fantastic points. And I want to tap in a little bit to what you mentioned a little bit about that strategic side of it. Do you think a strategic workshop could improve efficiency ratios, or what role would it play?
I mean, the workshop itself probably wouldn't. Me maybe be able to find a couple nuggets, but it's the start. I think getting a plan and then working that plan, as we're always taught, right? And this probably won't be an overnight thing. It's not like, hey, have one meeting and next thing you know, you pop out and you save some money. It's probably identifying where those low-hanging fruit lie. What are the longer term initiatives? Because again, I get it. You got contracts that are up at certain timelines. Nothing ever seems to line up. But at least getting a clear picture, a multi-year picture together, and a roadmap of how we're going to get there. It's something you can then present to your board, right? It's then something you can then present to your team and say, hey, here's our path to from 90 to 88%, or from 90 to 70, like wherever we need to get to, and how we're going to do it. But at least at that point, the entire team's on the same page on the how of what we're going to do. And I think that workshop that at least we're talking about here is that first conversation to say, hey, what are the options? What's possible? And how could CSG potentially, in this case, be a partner to help you get there?
Yeah, just to bounce off one quick idea that Scott said is one thing that I think is shocking, not only to CSG, but I think to all partners out there. We know that banks or credit unions are meeting on 5-year strategic plans, 10-year strategic plans. And it's interesting to me on why they don't involve their partners in those plans. So that would be the biggest question I would ask if me, myself, being an executive at the bank is, hey, do I have the proper partners involved? That as I'm planning, can I bring them in to be part of my plan and ask them, hey, how can you help me drive efficiency within my institution? I do feel like that's a plug for CSG. That's one thing we do really well is we're always involved in that. But I would open that up to all of your relationships out there from a technology and a service standpoint. Hey, have you invited those people to the table to understand? It's really important to understand where their company is going over the next 5 years too. Do both your strategic plans align for the future and the vision of what both organizations are trying to do in the near and long term future? Because if you have no idea what XYZ company is doing in the next 2 or 3 years, it may be completely different than the direction you're trying to go. And you're making these decisions based on assumptions of history. So I think that would be one thing that is part of this. Why is a strategic workshop so important? It's important for the FI individually, but it's also important for the FI to involve their partners so that they understand the strategic layout of what their partners are doing too. Hey, what's on your roadmap? Does it align with ours? I think those are all conversations that sometimes get overlooked that are very, very valuable.
Well, sorry, Brad, I cut you out. We're going to vibe here for a second. But for those that follow me on LinkedIn too, I posted last week about just this idea, like, why do you buy what you buy? And the same idea, like, man, culture is so important, right? Not only just within your organization, but culture and matching that culture with your vendor partners, I think is super key, right? It's not a conversation of, hey, it's just a dollars and cents conversation relationship and save me money here, or bring me this, or like those are sometimes they happen and those are tough, right? But when Scott's point, if you're actually looking through and you're both organizationally aligned on that key initiative and you have confidence that that vendor partner is there culturally kind of working towards helping you figure that out, because guess what's going to happen? We're going to take from that meeting also, hey, what can we do better? Where's our roadmap need to go in order to help you achieve that goal too, if there's a gap on our side? Where sometimes vendors say, I don't care, right? This is the contract, you're stuck to it, and good luck, go talk to somebody else. Like, that's never been our motto with this. It's like, hey, that's a good point. Let's look internally here and figure this out. And then where are our gaps and how we can work with you together to be that partner with you in 5 or 10 years from now, so we're not, outside looking in. So I would not overlook at all the culture and the aspect behind the companies you're working for. Does that align with your company and your bank or credit union? Because
sure,
you got a vibe.
Yeah, I agree, and I appreciate the conversation. Now, you mentioned a little bit earlier about kind of getting that C-suite together to make these decisions, but a lot of times these decisions end up getting siloed. Like the operations does their own thing, technology does their own thing. So how can those departments really create that operational complexity that brings up that efficiency ratio?
I think internally, right? And I get it. Sometimes it's, especially who you're talking to, like, I don't want to bring this up because I don't want to overstep, or hey, this is my world, you name it. I think helping other departments understand how a decision could impact their department is a good way to start, right? So a good example, say we're working with someone on the ATM side and they're dealing with ATM fraud. If there's a security solution, like maybe tying in cameras to electronic journals to help with just Reg E claims, for example, bringing that to and say, hey, I've got a partner here that could help solve a problem for you, other department, right? Then that kind of thing sometimes brings them in naturally to have that conversation. Sure. Because it's just because it's, hey, I own ATMs or I own TCRs or I own access control or alarm, whatever it might be, and staying in that lane. I think culture bet is like looking outside of that saying, hey, I know that a partner of mine was having this issue. Let me bring this in and bring that conversation to the forefront, because we're seeing it. We've been talking about this on video surveillance side for a while now, where video surveillance, right? You ask anybody in the world, it's a camera security solution. If I get robbed, then do I have the video footage to show it, right? If I had an event here, do I have video proof that it happened? Like, in my opinion, I've said this before, I think it's an absolute waste of money. Like, it checks the box on the regulation side that, you got video for 90 days, and if something happened, you got it. But wouldn't it be great if I was in operations and I could know how many people came into my branch every day without having to buy another product from a different vendor? I could just simply turn on a line crossing analytic on my video surveillance platform that's already in place, and now I've got my problem solved. Cool. Done. Easy. Super simple, right? So as a security professional, I can bring that to the operations team and say, hey, this vendor here that we've been working with that's already vetted and worked with our company could do this. And oh, by the way, it might reduce our spend because we're doing more business with them. Bang, win-win. All of a sudden, efficiency ratio starts to drop a little bit because the spend goes down, and we're reducing vendors and we're consolidating it through. So same goes with retail, right? Like, hey, retail could use some analytics and insight that video could bring. Marketing could do the same thing. Like that list goes on of saying, I've got a platform. If we think differently, it could benefit other partners within our organization. Let's bring them in and let them know about that and let them make that decision.
Yeah, I'll add just a little bit different flavor, but kind of reiterate what he's saying just a little bit. I think when you get into these silo type situations, and we all do it. I mean, I'll be transparent with you. CSG has a very siloed organizational things that we overcome, and we've been able to overcome those things. And I think one of those, honestly, is just communication. And I think that kind of bounces back to your additional or your original question, like, why is a strategic workshop important? It's important for everybody. And the one thing to understand too, and whether it's CSG or it's Fiserv or it's whoever you guys are working with, you bring that organization in, they can't fix your problems. But what they can do is open the door to communication. So that's, I think, is why it's really important to have a strategic conversation. I think a lot of times when people are meeting with partners, vendors, they're meeting with that one individual on that one different department. I think that's where we're trying to change the mindset a little bit, is to be like, hey, let's set these strategic workshops up. Let's get everybody in a room and let's discuss how these benefits can help you. Like Scott was talking about, hey, could my marketing budget pull from my security budget? And could we make a really nice solution that way? So I think that's the biggest thing with overcoming kind of those silos is let's kick the doors down and let's make sure we have the proper partners that are available to kick those doors down. And when we meet, it's okay to meet one-off with your partners. Those relationships are important. But once a year, you should be sitting down and road mapping what you're looking to do the next year as an organization, not just a department.
I think those are all fantastic points. And I think it goes really well into our next question, which is, what kind of questions do you want to be covering during those strategic workshops?
Man, again, if we're talking dollars and cents, right, it's like, what's driving that up? Like, let's get to brass tacks and not sugarcoat stuff, because sometimes it might be like, hey, we're embarrassed that our efficiency ratio is this high, or we're working towards this. Like, being transparent, like we value transparency probably to a fault. We probably say way too much. We probably go into detail too far. But to be honest, like, you can't really be a doctor and solve a problem if the patient's holding back on you, right? So I think the reality is yeah, you got to dig into what's causing this to go up. And there's probably some really good things that are causing it to go down too. And understanding both of those pieces. The other piece I would say is like, man, there's some unique aspects of this. And this is probably why, to kind of drive home why it's important to bring some outside perspective here, is us working with hundreds of institutions like them throughout the world in different markets. We can give some ideas they may not be aware of, right? So sometimes we get stuck in our world, in our wheelhouse. Okay, how do we solve our problem right here within my branch or this or that? And then you invite in a partner that can bring that strategic thought to it. We can bring some insights and some strategies that have worked for others that they may not have thought about, that may be different. And that could be all it is to then take them to that next level as far as looking to where they want to go.
Yeah, I think that's a really great point. And Scott, I've heard you all have a guide to one of these strategic workshops. Can you share a little bit about that?
Yeah, so in that guide, there, I believe, are 10 or so questions in there that you can talk through internally just before setting up a meeting with a vendor or partner there. Again, high-level questions in general, but it's several questions at least get you started if you're kind of stuck on at home plate, not sure where to go. Start there. That's an easy free guide. You can download it on our website. We can send it out here after the podcast as well, and that should at least get you going in the right direction.
Yeah, I think that's a really good point. And I think this really ties into what we were talking about a little bit earlier, which is vendor creep. So obviously that can drive a lot of inefficiencies. So how can FIs really handle that vendor creep? Because it's very easy. You pick one here for something, you pick another for something else, and by the end of it, you've got 10 different companies working with you.
Yeah, in my opinion, that in itself is an exercise. Again, probably something that can be done internally too. But I mean, that in your platforms, it's interesting. If you do the exercise and you maybe ask the department to say, hey, tell me all the vendors you're working with, and you ask that same question to an executive, I almost would guarantee those two responses and list of vendors are going to come back different.
Right.
Because slowly, we call it creep, not because like they're creepy. They're like, oh, like,
Right. Yeah.
it slowly
Just
happens
creeps
and
up
you
on
don't
you.
realize it. It creeps up on you.
Right.
Platforms is the same thing. And so, yeah, I think getting that exercise going where let's go through this, look at your spend, where is it going, find out who your vendors are, and then kind of then analyze it and review it. Like, are these partners, are these vendors? Just knowing that two distinctions is going to tell you probably all you really need to know as far as where you want to continue to do more business with. But yeah, I think at least having the framework, have it written down on a whiteboard, wherever it is, saying, hey, here's where we're at today. Cool, we got our baseline. Where do we want to be to next year, 5 years from now? Which partners here are going to get us there? Which ones can we do without? Where can we consolidate? Where can we improve? It'll probably paint you the picture pretty quickly once you have that, at least on paper.
Yeah, I'll throw in kind of a funny story. And to Scott's point, sometimes we're a little bit too transparent. This one actually got me caught with my pants down in another word. But this was a very large organization that I had worked with for years. Some new people had shuffled around and whatever, and they were doing this whole thing that we're talking about, their own version of a strategic workshop. And we had a guy from one department go, okay, list all your vendors out, and he throws out that, hey, we use CSG. We have another guy from another department right there in the meeting go, oh, wait, what? You use those guys? I do too. And right there, I was like, oh my gosh, what did we do wrong here? How did we not consult? How did we not help? How did we not do those things? And those are some of the gaps that we would like to control and help with you guys, because to Scott's point earlier, lo and behold, we were then able to have some integration points. We were able to consolidate some certain products, and we were actually able to save them a lot of time and a lot of efficiencies, that now they're logging into one system to view their events rather than these two different people going about their day to day, not even knowing that they're using the same vendor for two different products. Right. And it's a little bit scary from my perspective that we're not doing our job, and we're definitely trying to get better. But it's also very scary from the customer's job. Like, hey, do you guys actually know how many times your webs twine together without you guys even knowing that? And I think that these are all discussions that get overlooked a lot because we all get really busy. But if you could just take a moment, take a step back and look at that, I think that there's a lot of visibility and a lot of growth that can happen that way.
Yeah, very solid points. So I want to tap into something very, very specific. So talk a lot about technology, how technology can sometimes help with the customer experience. But in what way do you think it can help that operational efficiency, in your opinion? What's like some concrete examples?
I think that's a scary question to ask in today's environment.
Sure, absolutely.
Yeah. So I mean, the biggest buzzword right now is everybody's AI, right? Do people really understand what that means? Do people really understand how that can be implemented and the strength behind that? And to be transparent, if your partner vendor is not looking at how they can leverage this technology into gaining efficiencies for your institution, you probably need to have a deeper conversation. But I think from customer experience and technology and all of those things is not being so far off on the bleeding edge that you get yourself in trouble, but also understanding the market. I'll give Scott Fieber a little bit of credit. I almost go back to the mindset of 1% better every day, right? If we can focus on that and we can make sure that we're doing that, hey, learn something new. What is available and out there? It's funny to me as I work with banks and credit unions. You know, a lot of them are very forward thinking. Yep, we're doing this AI. We've done all of these things, and then other ones are like, no, we don't want to touch it. So my challenge would be to find that fine line within your technology. Sometimes I think we get a little bit overkill. There's something new. We want to jump all over it. That's how vendor creep happens. That's how all of those things happen. And then there's also the back end of that is to where people are very reluctant because they jumped in new on something. So I guess that would be my biggest advice on how do we leverage technology would be learn about it, understand it, and then learn how to implement it and make sure that you know exactly what you're getting into and how to utilize that certain piece of technology.
It's a great point. Sometimes you can give people tools they don't necessarily want. So something that needs to be worked out in the strategic workshop and on every level within the
Well,
organization.
it's interesting too, because sometimes you buy a technology, right, and you're probably only leveraging 10% of what it can do because it's only fitting the needs of the person that bought it. It's like, okay, again, if we're open to this idea and we're bringing the entire organization, you probably could leverage more of it, again, without having to buy some other product that's doing the exact same thing right next to it in parallel. Solid example, check imaging, right? Most institutions have a check imaging platform for different channels, and they're double, triple, quadruple paying in some cases. I've got a check imaging channel for mobile banking. I got another one for ATM. I got another one for RDC. I got another one for teller. What the crap? Why? Like, can we have conversations and see if maybe we could simplify that down from 4 to 1? Savings made. Simple stuff sometimes, but again, without doing through the exercise and going and figuring that out, you're never going to know, and you're just going to continue to spend more money and not realize where that money is leaking.
Sure, great point. So I want to ask something very specific. It's about the bottom line. What strategies can increase deposits in this competitive market we're in?
My latest thought on this is, again, trying not to think like a bank or credit and kind of think like a business in some cases. And sometimes they seem so foreign because like they're the ones typically financing the business deals. But we've had a lot of customers recently increase deposits through more real estate initiatives. And there's some regulations around all of this stuff, right? But yeah, sometimes they're looking at, hey, let's buy some land without going through the millions and millions of dollars of actually building a full-on brick and mortar. Maybe leverage ITMs or other technologies out there can do it cheaper without hiring dual control and all the staff that goes along with that. Test the market a little bit. If it works, great, double down, you got the land, you move forward. If it doesn't, you're making money on the real estate transaction, right? So your profitability is going up through that. And if you did obtain some new deposits that way, great. We'll find ways to service those accounts. But again, whether it's through digital, AI, there's so many different pieces here. But for me, like above all of that is truly understanding your identity and what actually makes you different. Mm-hmm. Like if you were to go pick somebody, I'll just give you just some homework, right? Go talk to someone that's not living in the banking world today and just simply ask them what's the difference between a bank and a credit union? What's the difference between bank XYZ and bank B there? I would guarantee no one's going to be able to tell you the difference. They both offer checking. They both offer savings accounts. They offer a loan if I need it. They have a credit card. Like, why are you different? And if you can truly and succinctly explain that to a common individual who's not living in this world every day, you'll start to see your deposits go way up, in my opinion. And there's reasons for that. They all know those. But again, the strategic workshop's there to help you figure those out and then double down on those efforts to really bring that home. For the common person like you and I always talk about the difference between a Home Depot and Lowe's. Like, what's the difference in the logo? Most people don't know, right? You talk to the experts, they're like, oh, well, Lowe's is more organized. They cater more to female than males. And Home Depot is more catered towards general contractors. It's like, I don't care. For me, I'm going with everyone's closest to my house, probably.
Exactly.
Right? And so when you talk about people, especially upcoming generations, say, hey, why'd you choose to bank with who you bank with? Even if there's no intention of actually visiting that branch, they go with whatever's closest because they're seeing those logos, they're seeing that, or mom and dad did this, or whatever it might be. The way technology is going, I think you can definitely find ways to be unique and set yourselves apart. And that's going to, what's at the end of the day, is going to drive deposits for you.
Yeah,
if that's what you're looking to do.
This may be a little bit of play back to your previous question on, hey, how can technology leverage, how can you leverage it for having customers join and all of those things? That is one thing that, and I'll echo what Fieber said, is a lot of times we don't look at banks and credit unions as businesses. They are. Like, you guys got to understand that is a business. And what do I find when I'm looking for businesses, when I'm out trying to purchase somebody that makes it easy? Make it easy, make it visible, make the location great, make your digital presence great, all of those things. If you make doing business with yourself easy, I think that's where how you can increase customer member type deposits, new account growth, all the things people are looking for, new loans to have. I think it's leveraging partners and technology to make it easy to sign up for whatever product and service you want.
Excellent point. So I got one more question for both of you, for both of the Scotts. If you were the CEO of a bank or credit union, what would you tackle first to reduce your efficiency ratio?
I don't know. I can answer that without, because again, everyone's so unique on it, right? That's part of the problem is everyone thinks, hey, a bank's a bank, a credit union's a credit union. They ain't. They're all different. They have different issues. So honestly, I don't know. It can be a wide range of things. Probably generally speaking, it's just I would get a lay of my land. That'd be the first bit. Who am I doing business with? What am I spending my money on? Where are we at? Where are we going? And who's going to help me get there? And have those conversations with those companies and with that team internally and see what comes out. Because there's probably not one silver bullet that's going to make it happen, but there are definitely some very easy things to do to start getting down that path and figuring it out.
Yeah, I was going to say, if I was a CEO, and Scott did a good job saying this, but I think the number one thing that I would probably look at is inefficiencies. Where do I have multiple people doing something that they don't need to be doing this? And how can I reallocate those inefficiencies somewhere else? Those resources need to go somewhere else. So how can I cut down on my inefficiencies? That would be probably the biggest thing I would look for at a CEO is where am I spending a bulk of my time and my money that's inefficient?
Leaking oil. Can't win a race leaking oil.
There you go. All right. Well, I want to thank both Scott Smith and Scott Fieber. Loved having both of you on. Had a really great conversation with both of you.